it might take getting to that extreme for that kind of behavior to occur again. And that's not that's not what's going on right now. And I agree with you. I mean, 38 billion of debt or trillion of debt, 34, whatever. It's not a big difference, but at some point, there's a tipping point where, something breaks. And
Hey guys, welcome back to Everyday Finance. In this video, Larry Lepard discusses about Fed price and GDP growth, according to Larry Lepard. The last time our debt to GDP ratio was this high, 130%, on a certain point, the bond market rebels and the YCC had to control the yield curve after that because of World War II. Prices went up a lot in the late 1940s and early 1950s. And Larry Lepard think you're beginning to see that. For example, you had a 30-year sale not long ago that didn't do very well. And a few years ago, the term went from about 4 years to 5 years, which led to this abrupt change level up really quickly. That made me think a lot of the gilt problem that happened in the UK in September of 2022. So Larry think the debt does matter in the end. They care about it because we all remember how important it was in March 2020. The debt market pretty much shut down and lots of things Larry Lepard discussed. So please watch the video to end and share this video and subscribe our channel Everyday Finance. Thanks.
We're talking, I mean, the two sides of the same coin, right? Because the spending leads to the debt, right? I mean, it's the spending that leads to the deficits, and I don't disagree. The government is acting like a heroin addict. I mean, there's no doubt about it. And yeah, I mean, I think we're saying the same thing, just with slightly different terminology. I think it does. I don't know. I think though. I mean, if you look at the last time we had debt to GDP like we do today, 130%. Eventually the bond market kind of revolts. And, they had to do YCC, yield curve control, as you know, post-World War II. And that led to the inflationary years of the, late 40s and 50s that you alluded to. And so I think, and I think you're starting to see that. I mean, you had a 30-year auction that didn't do very well a month or two ago. And, I think what led to this pivot more recently was the fact that the 10-year had gone from kind of the 4 level to the 5 level very quickly. I mean, that kind of reminded me very much of the gilt crisis in the UK in September of 2022. And so I think the debt ultimately does matter, George, in my view. And they care about it. I mean, we know it mattered in March of 2020 when the debt market kind of went no bid, and Powell basically came in, and this, we're saying kind of the same thing, but he came in with the ultimate put where he more or less, behaved like Mario Draghi and said, whatever it is going to take. And as you recall, I mean, they were buying corporate bonds, they were buying everything under the sun. They did TAF, they had 7 programs where they were just going absolutely nuts. That's how scared they were about the debt market imploding and about people not being comfortable holding the debt. So, it might take getting to that extreme for that kind of behavior to occur again. And that's not that's not what's going on right now. And I agree with you. I mean, 38 billion of debt or trillion of debt, 34, whatever. It's not a big difference, but at some point, there's a tipping point where, something breaks. I mean, and we can go through all these breaks. I mean, LTCM was a break. 2008 was a break. 2019 was a break. 2020 was a break. I mean, we've seen it. We've seen it over and over again that, the system continues. Something breaks. March of this year was a break, right? With, Silicon Valley Bank. Something breaks and they are forced to step in and provide the put, which, any way you look at it is a money print, right? I mean, the BTFP was a money print. I mean, they say it's a loan. They say they're going to unwind it. I don't believe they will unwind it. And, more or less they were buying assets that were worth 75 cents for a full dollar. So they were saying,
when we're talking about printing money, Larry, most people would consider that in terms of consumer price inflation.
Correct.
Right.
Yeah, correct.
So if it's a transaction between 2 banks, it doesn't impact M2 at all.
No, I understand that, but the fact that the banks are made whole allows them to go back to doing what they do, which does affect.
Larry Lepard believe it is safe to say that by definition, Larry do mean the Fed put basically prints money for everything, since every time they save a bank, that bank's the balance sheet doesn't go away. So that's part of M2. By this, we have an underlying put in the economy is the real problem, and so on. This is a machine, a flywheel that needs to keep growing because it's on Larry Lepard Twitter feed. You can't keep adding to your debt faster than you can pay it off, as Larry said in Tweet GDP, because that's what pays off the debt. So there is a major gap in this broken Keynesian system that lets people, banks, and others get away with things to keep taking risks they shouldn't be taking, and to keep taking on more debt than their output grows at a faster rate than it grows. Let's back to the Larry Lepard interview.
I think that it's safe to say that, yes, I mean, the Fed put, by definition, becomes money printing for basically everything, because as you point out, every time they save a bank, that bank's balance sheet does not disappear, and therefore that's part of M2. So yes, I mean, the fact that we have underlying put in the economy is the real issue. You know, and so, I mean, this is a system, it's a flywheel that has to continue to grow, because as we all know, you know, the other thing is on my Twitter feed, my pinned tweet is, you can't continue to grow debt at a higher rate than you grow GDP, because the GDP is what's used to service the debt. And so there's a fundamental disconnect here in this broken Keynesian system, which allows the banks and others, you know, to continue to take on these risks that they should not take on, and to, you know, to increase debt at a rate in excess of the underlying growth of productivity and GDP, knowing that when it breaks, which it will, and it has on multiple occasions, they will be bailed out. And so yeah, I actually would go with your prior definition. All of these things are money printing in an indirect fashion. Yeah, I might take a little bit of issue with that, because I think, you know, it depends on how they increase their balance sheet. I mean, if, you know, I know that there's
mortgage-backed securities or treasuries.
Yeah,
I think that's a fair point. I think that's a fair point.
I mean,
so if they're buying all mortgage-backed securities, then you're going to reduce the spread. Maybe the mortgage rates come down, and that could lead to more lending. Okay.
Yeah, I mean, I think there is a chance that the Fed. I mean, look, we're all saying kind of the same thing. Where I think we're getting twisted in our underwear a little bit is just in the actual monetary plumbing and all of the various ways the money flows. And I don't disagree with your criticism that I'm being slightly inaccurate when I say the Fed is printing money.
And the only reason I'm being critical is because at the end of the day, it really does matter. It's not just splitting hairs. If you're trying to figure out the probabilities of consumer price inflation or the stock market or the bond market or interest rate, this stuff matters.
I agree with that. But I think you would have to agree that everything I've described at a global macro level over a long enough time frame does lead to expansion of the monetary base, and it is that expansion of the monetary base which does ultimately lead to consumer price inflation. Correct? No.
I agree that you're going to have money supply increase with GDP, population, energy, whatnot.
Right.
But I don't think the base has anything to do with it.
Really? Okay.
No, because if you look at where I'm getting that, Larry, is because if you just look at the Fed's balance sheet, there's really no correlation with M2. And in fact, if you look at prior to the
Fed, slow down. I mean, let's take the 2022 example.
Well, that's one. I'm saying if you look at a long period of time, there's no you could just flip a coin, and it is true, absolutely.
I mean, in the 2022 example, the Fed balance sheet grew enormously, and M2 grew 42%, right?
According to Larry Lepard, the banking system knows there is a Fed end of story. They are free to do what they want. And Larry Lepard thought the BTFP was very interesting because if you remember the time frame, you know that Janet Yellen changed her mind a few times when she said they might have to back up the whole $1 trillion deposit base. Larry mean that would be a big deal. And they were very worried when it all happened. If you learned something from this video, then please like this video and subscribe our channel Everyday Finance, and we will meet in next video. Thanks.